What's up guys, how's it going? Welcome back for another video on the channel. In today's video, we're going to be diving a little bit more deeper into my margin account. I'm going to give you guys a quick little update on that, since in the previous video I talked about I was going to make a plan and stuff like that. So in today's video, I'm going to kind of show you guys what I'm going to be doing. I'm going to be doing a bit of a deep dive into the plan, to the strategy, basically give you guys an idea of what I'm trying to do and show you guys what I think is a smart and reasonable way to use margin on Wealthsimple if you guys want to go down that route. Now I'm going to say really quickly before we go into this video and before you guys even think about doing something like this, be sure to do your research, be sure to know what you're getting into. Margin is not something you have to do. In fact, we built my entire portfolio from scratch without margin. So it is really like a leverage tool that you guys can use if you want. But keep in mind that we didn't use any of it and you guys don't have to in order to create wealth. And there's going to be a lot of people out there who aren't going to want to use margin at all. And that's perfectly fine. There's going to be a lot of people who might want to use it a little bit to get a little bit of leverage and be conservative like I am. And there's going to be a lot of people who are probably going to abuse it. And we're trying to avoid that. And I'm trying to show you guys smart ways of doing things. And again, at the end of the day, you guys can decide what's right for you. But I'm going to give you guys a quick little rundown of our strategy, what we're trying to do, and also give you guys an update because this is going to be a bit of a case study as well, since I've been kind of experimenting with this as well. And obviously, since we haven't had this account for a long time, it's pretty new, it's pretty brand new, we haven't really seen much happen in the market. So obviously the big test is going to be when markets either go up a lot or they go down a lot. And when it comes to margin, obviously it's going to be when the markets dip quite a bit here. But anyways, I'm going to give you guys a quick little rundown. So like I mentioned in the last video, I made a post on Blossom. I basically outlined my strategy. I'm going to go through this little bit by little bit to show you guys kind of what's going on here. So the first thing I'm going to cover is the total portfolio. So we're using the TFSA basically as leverage or collateral in this sense. What Wealthsimple does is it lets you borrow money based on your assets, so to speak. So what we're using is our TFSA. The amount we have in our TFSA is going to determine our buying power. So if I go inside my TFSA here, we can see we have $180,000. Now, when I did the post write up, it was $177,000 we had in our TFSA. So obviously, as the markets go up and as we put more money in, that's going to increase the TFSA. It's going to grow. It's also going to increase our buying power over time. So that's a nice little benefit there as well. And the other benefit about doing this later on in your investing journey is you already have a nice bit of cash built up. So you can take on less margin risk and still have it somewhat be meaningful, because the way it kind of works is we're going to go with percentages here. So I'm going to kind of go with 5-10% margin kind of thing, maybe 15%. We'll talk about that as we go further. But because we have a higher portfolio value, that 5 or 10% can actually start to kind of actually be a little bit extra money that's decent. Now, if you have a small portfolio, it's only a couple $1,000 or $20,000 or something like that, like you're just getting going, obviously margin is not going to be as impactful and you're going to have to take on more risk to have it be more meaningful. Nonetheless, you could still do the same thing, and there is some benefits of doing that as well with a small account, because then you can put regular deposits in. It's easier to kind of top it up and different things like that. But nonetheless, we're kind of approaching it like this, and I think this is a smart way to do it. And also doing it this way, it allows you to get your feet wet with regular investments. It allows you to get some skin in the game. It allows you to kind of experience the ups and downs, and then when you're more responsible, you kind of understand things, then you can maybe get started with margin. So I'd recommend you guys do the same, but of course you guys can do whatever you want to do. It's up to you guys. Just be warned that, you know, if you're not careful with margin, it can cause you some big problems here. And if you don't like debt, you don't like any of that stuff, then I would recommend that you just don't do it at all. And they're both very good, both fine options. Just be responsible. That's all I say in these videos. That's all I recommend. So here, the first thing I'm going to cover is the ETF allocation. So we have 3 funds inside the margin account. I'm going to kind of explain why we have these different funds. So I want to keep this as simple as possible. We picked ETFs because ETFs tend to be the most safer funds. Investing with single stocks and margin can give you good rewards, but it also is riskier. So if you have different funds, right, like VFB, we're going to use VDY. These are the 2 Canadian and American markets. You could add like a global fund or a fund in some other country or something like that, right? Like a European fund or Asian markets, whatever you guys want to do. That's up to you guys. You could, or a global one, like, you know, any of the ETFs they have to kind of add a little bit of extra exposure. I decided not to do that. I'm just going to go with VFE and VDY because, again, I'm more focused on North American stocks. I'm kind of doing that for the growth, and it's worked out pretty well for me. But we have a split because, once again, ETFs give you a basket of stocks. So if like a certain sector goes down or like financials take a big dip or something happens, at least the overall ETF will stop you from getting those big drops in the market. And that's going to be very important when it comes to margin, right? You want to kind of reduce, you don't want to have crazy drops, right? And we'll explain this as we go. So VDY, we have 40%. That's going to be our Canadian exposure. We have VFB 30%, and then the other 30% is going to be HDIV. And the reason for this is to help pay for the interest rate. So margin accounts do have interest rate. The one on Wealthsimple currently, it depends. You guys have to look it up. We're currently sitting on a 4.9% interest rate, and this interest rate gets charged daily. So if we go inside the portfolio, inside the margin account here, I'm just going to go back out here in just a second. Actually, what we could do is I could give you guys a quick little update on the performance so far. Well, actually, we should have done that first, but we'll do this really quickly. So all time, we put $50 inside the margin account to begin with. That was our first money we put in. And here's the holdings and here's the return. So we have HDIV, VDY, and VFE, and we've seen a little bit of a gain in the market so far. And if we click over to the right here on this little tab here, you guys can actually see different information about your margin account. And I'll try my best to kind of explain this and as easy as possible. So this margin used is going to be the money that we currently have that we're using on margin, aka your debt that the money you're borrowing from Wealthsimple. So we currently have about $2,000, about $2,500 that we're currently borrowing from Wealthsimple that we're investing in margin. Portfolio value for the TFSA is 182,000. That's 180, I believe, plus the margin. So keep that in mind, like 180 for the TFSA, and then the $2,000 for the margin. I think that's the way that works. Your margin requirement here is going to be how much money you have to hold inside your account at all times. So my TFSA basically, and the margin account included, we have to keep that above $54,000. If we drop below that, then you have the risk of getting margin called. And that's where the brokerage will force you to sell your assets. So as you can see, margin, if you're too leveraged or if you're investing too much, or if there's like a major catastrophic drop in the markets, it can ruin you. But it's mostly for people who, like, if you're going to over leverage, like most people will leverage like 30%, 50%, those kind of, like, that's getting into more of the riskier territories, because your portfolio would have to drop it a lot. Like $182,000, we would have to see more than like 60, 70%, 80% drop in the markets. That's pretty crazy, right? And that assumes you're not putting your own money in, you're not getting dividends and other ways of bumping cash up. Also, if you have cash on hand, you can always put cash into the account, and that's going to help it out. And all these different things will help keep your margin relatively low. The biggest danger with investing is you have to be conservative. You have to not be greedy. That's the biggest thing, especially when markets drop, and we'll talk about that as we go through here. But just to give you guys a quick little explanation of how this works, that's how it basically works. And your margin available is going to be how much money you can actually buy. So I can buy about $125,000 in margin. And max buying power, that's how much I could buy in max. And again, Wealthsimple puts this up here. Again, you never want to use your max, because max buying power is crazy. Like, if I put that much money in the markets, your portfolio, like any kind of drop in the market, because your leverage so high, could force you to sell, and it's just not a good idea. So don't do that. I know it's enticing, it's a big number, but just don't do it, guys, even with an ETF, because even though you might be okay during dips and drops, and when, just to be 100% clear here, guys, in my TFSA, my regular portfolio, my personal savings account, my RSP, I will buy no matter what. I'll buy if markets are good, I'll buy if markets are down. I don't even think about it. I just put the money in buy, because I know that markets will go up over time, and I don't care if they go down. And if they do go down, I'll just hold it. But again, when you're borrowing money, they want their money's worth, right? That's how they make money off margin with the interest rates and stuff like that. So they want to make sure their assets are protected, especially if you're investing in speculative stocks, right? They don't want like the stocks to go down to nothing and then they lose all the money, right? They'll force you to sell if it drops by too much. So again, be careful with that. And it's a little bit different than my regular investing plan. In fact, the margin account is completely different. So just kind of keep that in mind, guys. And I just want to say before we go any further here that I'm not an expert on this. So like, if you guys do your own research, don't listen to me. Don't do anything based off what I'm saying here. I'm just somebody who's kind of dibbling and dabbling in this, and I'm not an expert. So just keep that in mind. I want to keep saying that and let you guys know that. Don't do what I do, and then if something goes wrong, because I really am just kind of trying this out for myself and trying to do this in the best way possible. The reason why I want to set up this setup with these allocations is because, as you guys can see here, I wrote in my Blossom post, U.S. stocks get growth, Canadian stocks for the dividends plus the growth, and then obviously the ETF from HDIV for the higher yield to help pay for the interest. Also, you get a little bit of diversification. I personally find U.S. markets and Canadian markets seem to go opposite of each other. So generally, if there's a good year in the markets overall, usually both U.S. and Canadian markets will go up. But I also find when U.S. markets tend to dip, Canadian markets tend to go up, and you kind of get a nice little balance there. Not always the case, but I have noticed that tends to happen. So it can help you kind of balance your portfolio, so you're not seeing mega the dips. And again, this wouldn't normally matter for a regular portfolio, but you want to be careful with margins. Here's our margin parameters. So our initial margin was 0%. As you guys can see here, we started with nothing inside the margin account. And our goal is to hit about 15% max. And I'm going to kind of lay this out as we go through here. So the deployment rules, this stuff isn't 100% set in stone. It's just kind of like my recommendation. I kind of set this up. It's just some general rules that can be flexible, and I'm not 100% sure on this. But the idea is to start low and begin with a 5% margin. So 5% of 180 is going to be roughly about $9,000, I think, give or take $9,000. So that's our max that we can buy when markets are at an all-time high. So and the idea, like a lot of people will say, like you don't want to buy in margin when the markets are all-time highs, because what if the market dropped tomorrow? You put all your money in, let's say you buy the 5%, 10, 15%, 20, 30%, whatever you want to do all at once, but let's say markets drop 10%. Well, now all of a sudden you're down 10%. So the smart thing to do with margin is to always deploy it slowly. And also if markets are all-time highs, you want to kind of do it slowly as well. And even just small amounts. So what I've been doing on a regular basis is I will go, for example, we can see here we have today's price for, this is Wealthsimple's today's price. So when the markets open in the morning, I just take a quick peek on here. I see, okay, what's down for the day? We have VFE down today, right? Negative 28%. We have VDY down negative 23%. I'll buy. I'll be like, okay, I'll put $100 here, $50 here, $100 here, and I'll base it off the percentage of how much they're down. So let's say VFE is down like 0.7%. Okay, you know what? I might buy like $150, maybe $200 if it's a full percentage point. Same with VDY. If it's down only 0.10%, okay, that's not that much. We're only going to buy like $50 or $10 or 50, whatever you want to do. Like again, based off what you guys are going to buy. And naturally, you'll see that the values the allocation kind of gets a little bit skewed a little bit because you're buying whatever drops. Like if HDIV or VDY doesn't drop, you're not going to be buying it that much. So what I try to do is whenever the funds do drop, I try to make up for it a little bit, because you're kind of rebalancing this on a regular basis, but it's okay to be a little bit off because that's just the way it's going to go. And lately I've been buying a lot of VFE because it has dipped quite a bit. We saw a nice little dip for VFE over the past week or so, or like not overall, but on a day-by-day basis, right? So we've been buying, and we only buy during dips. I don't buy anything on a green day. And what I'll do is I'll check in the morning and then I'll check in the afternoon. Markets close. And again, guys, I'm going to be doing this for now. At some point, I'm probably just going to get tired of doing that, and I might just do it once a day. Maybe I get tired of that and I just do it once a week. Maybe just once a month. You know, you guys can streamline it, but because I'm really focusing on this and I want to get involved with it, and I kind of like it. I think it's kind of fun. It makes red days interesting and fun because it's like you can buy more funds for the margin account. And then green days are good too, because like it's hey, we're up inside the margin account. That always feels good. Gives you a bit of a buffer, right? Because any gain inside here, like HDIV, we're already up 1.51%, VDY is up 2%, VFE is up 1.32%. So if these funds were to drop, like let's say we got a -2 drop in VDY, every other, you know, like if you just bought the margin that day, or if you were a 0% return, you'd be down -2, but we would be equal. So by buying even when markets are high, like all times high, so to speak, but you're deploying it slowly and you're doing it on days when the markets drop, you help kind of take off the edge a little bit if the markets do drop. But if they bounce back up, you also get a bit of a gain, and that builds a buffer so that when markets go down over long term, your margin account doesn't suffer as much. Because like if you had like a 10% gain, you could take a 10% drop and you're just at neutral. So again, that helps your margin account out a lot to do it that way. So that's kind of why we're doing that. It's very safe. It's a little bit slow, but you could do it more if you wanted to. If you wanted to deploy it a little bit more quicker, you could. But again, I'm just trying to be a little bit extra conservative here because I really want to do this in the right way possible. So again, only buying on red days. Portfolio allocation is going to fall off a little bit. We're going to adjust that over time. When it comes to dividends and interest, this is an interesting topic, and I actually learned a lot when I was doing research for this. So HDIV, VDY, VFB dividends will cover the interest more or less. Like I mentioned, the interest for Wealthsimple is about, I think I have the generation account, it's 4.95%. I think the regular one, if you have the first account, it's like 5 something, and then I can't remember what the third final account. If you have certain amount of asset totals on Wealthsimple, they reduce it just a little bit. But I'm going to show you guys a quick thing on track your dividends, because we can actually see what our portfolio yield is, and also see what the interest rate is. All right, so here's the margin account on Track Your Dividends. So this is a cool little website where you guys can put in, whoops, didn't mean to click that ad there, where you guys can put in your portfolio, and I've been basically topping off the margin account. I kind of update it like every couple days or once a week or so. So this isn't 100% accurate, but I can put my holdings, I can put my shares, and I can see the portfolio yield, because it's hard to track it on Wealthsimple. It doesn't really show you. But on a portfolio tracker, I can see that, okay, my yield is 4.76%. And again, with my perfect allocation, we're sitting at about 5.3%. So we have a little bit extra yield, and I set it up that way specifically so we don't have to worry about the interest rate currently. And also, if it dips a little bit, or if our allocation gets a little bit off, at least it'll kind of more or less be there. And we can see that, like, my allocation is a little bit off. I got a little bit more VFV than I should. But even with that, we still have a 4.76 portfolio yield. So that's basically paying for the interest. So at this point, it's just the capital gains more or less, right? Like, so I don't have to worry about the interest rate. I don't have to worry about that. The dividend yield is covering that. And then we have the capital gain is the only thing I have to worry about. Quick note on margin accounts, they can increase the yield, the interest rate depending on the prime rate and stuff like that. So just pay attention to that. If any point in time it got too high, like if it was like 5, maybe high 5-6%, I probably wouldn't invest in margin. I would just wait till it basically goes up and sells, and then just wait for interest rates to go down. But keep in mind, your interest rates can also decrease depending on what the banks do and whatnot. So that's just something to keep in mind. The interest rate is not set in stone. It's determined by the brokerage. And Wealthsimple, I think, takes the prime and reduces it ever so slightly. I think it gives you a bit of a benefit, right? So just keep that in mind. That is something to watch out for. But again, it's not going to ever be a big jump. It's always a small increments, right? And the other cool thing about dividends is if you buy during the dips, you also naturally get a higher yield on cost. So like, for example, if VDY was to dip a little bit today, the dividend yield will go up because you can buy shares at a cheaper price. So then when you buy them, stock goes back up, you get a higher yield on cost. So really our yield on cost is 4.85%. So if you can buy in the dips and the portfolio will grow over time, your yield on cost will also help you pay off that interest rate, because the interest rate, again, stays the same in quotations. But that can help you pay for that. So your dividends actually make you more money and compound and grow, and then you can take them and reinvest them in, and makes you more dividends. So that's kind of how you can help to offset some of that interest rate, as well as pay off a bit of the margin loan if you want to. So that kind of helps you out with that. And any extra cash would just go into the account. Whatever, you could keep it in, you could reinvest it, you could just pay off the debt. It's up to you guys on how you want to do it. In terms of risk control, again, very conservative leverage, like I mentioned here. I'm going to start off with 5%. We're going to wait and see what things happen. 5-10% is probably what the sweet spot where I'm going to be. 5% during market all-time highs. And again, as my TFSA grows, as I put more money inside my TFSA, I'm going to be able to put more money in anyways. So it's always going to kind of be slowly growing. So even like a 5% is fine for now. If markets drop like at 5 or 10% over the course of like a couple weeks or month, I might put an extra couple of percentage points. And then again, if we see a big drop in the markets, like 15-20%, I might bump up to 15. We'll kind of see. It depends how things go. It depends on where my margin account is sitting at, right? Like if we're still sitting in a good spot, you can obviously deploy it. Again, generally speaking, you want to deploy more margin as the markets dip, because then you're offsetting some of that loss. If you put it all in right now, if you have your money invested while the dip happens, well, then you take the loss, right? But if you wait till the dip happens and then you invest, then you don't have to worry about that as much, right? So again, you can always play it on the safe side and wait and see what happens. And because margin, anything in a margin account is basically, it's extra money, right? Like it's money I wouldn't have invested myself. I could take this out and even sell some of it right now if I wanted to. I'm up $40. Like this is $40 I made from my account that I wouldn't have made if I didn't invest in margin. It's not my own money. So again, you guys can trim it off as you want. I'm not trying to maximize here. I'm not trying to get the best return. I'm not trying to be greedy. That's going to be an underlying theme, I think, with the margin account, is you have to take your wins when you get them. So what you could do is, even with a little bit of gain here, you could trim off a little bit. I'm not going to do it right now because obviously I want it to grow a little bit. But like, let's say, VDY was up 5%. We could maybe trim a couple, or let's say we're up like $500. I could take $100 off, pay off the loan, whatever. You could do that. So that will help you grow the account and whatnot. So just, don't be greedy with it. Be reasonable with it, and take any gain you can, right? When it comes to taxes, this is also going to be the big thing. So margin interest rate, apparently, if you invest in assets that generate you cash flows or dividends or anything like that, apparently you can mark it off as a tax credit. So interest from VDY as well as VFE. Yeah, interest from VFE and VDY is going to be tax deductible. Now HDIV does have some capital gains, some return of capital that, from what I understand, is not, you can't claim it as interest. So you just got to do your research, look at the funds. You could, if you're not happy with that, you could always replace HDIV with a high yield fund or something like that. I chose to use HDIV because of the high yield, but also because it's eligible dividends. So it does have some dividends, although it does have a good chunk of money from return of capital. So just kind of keep in mind with that. But any other the dividend income, the bulk of the dividend income we do make is going to be able to be tax deductible. So that essentially at the end of the year, you can claim that on your taxes and you'll get a couple, I don't know what the math would be, but let's say you pay a 4.95% interest rate. Maybe it bumps it down to like 4% or 3 point something. I don't know. Maybe it's not that much. I'm not too sure. I'm not good with the math on there. You'd have to look into it and research it, but it will help you get some money back that you paid in interest. So that is a nice way to offset some interest. So just kind of keep that in mind. That's something to keep in mind. But again, make sure you double check. You can actually go on the websites for the funds and check. So you can go into Google and type in, HDIV, distributions or taxes, and it will tell you on the fund websites how much is capital gains, how much is eligible dividends, how much is return of capital, all that cool stuff here. So that's a cool thing to check out. Stress test, again, this is just stuff to keep in mind. One thing that again you can think about is your dividends. All your monthly dividends will help grow the account. So let me just scroll back down here because it popped back up there. So any monthly dividends I get inside the TFSA, for example, our TFSA will help bump up our buying power, will help kind of balance things out. Same with the non-registered margin account. So anything we get, our own deposits as well inside the TFSA will help us kind of leverage things out. So again, over time, the account will grow. Our margin would be very conservative. We could even keep a 5% margin, put money in every single month, put like $500 a month in, which is kind of like your annual contribution room. Take the dividends, like I don't know how much I make from my TFSA, maybe like $300, $500 a month, something like that. I can't remember. That can go, and that'll kind of average down. That'll increase your buying power. That'll help offset if there is a dip in the market. It will help offset that because you're putting cash flow into the account. So that's a nice benefit there. Then that's how dividend stocks. And again, any dividend increases, the yield on cost growth will help you out there. So these are all different things that you can use to help offset some of the risk, so to speak, with the margin account. And in summary here, very, very high, safe, low leverage way to do it. It works really, really well. And I think it's going to be really cool. Again, if you guys don't want to do the whole margin thing, you guys can just watch me. I'll do it kind of thing. And again, just to reiterate here, I'm only doing this inside my TFSA, and worst case scenario, if markets did go down or something happened, we do have cash on hand. So let's say markets dropped a lot, we got a little bit whatever, we could always put some money inside the margin account or the TFSA, whatever we needed to do. But again, we would have to see some major market drops, and markets don't always drop. You don't see an 80% drop in the market just like that. It's like, that might be over a couple of years. So again, just a safe way to use it. But once again, if you guys are worried about this, if you're not too sure, just watch me. I'll show you guys how to do this. I think this is a pretty safe way, responsible way of doing it. And I'm also not sure if this is something I'm going to do long term. I'm just kind of trying it out. But I think, again, one of the biggest things I think with doing this type of account or investing this type of way is going to be, you can't be greedy. And you have to stick to your percentages. You can't, see the market drop and go, I'm going to put too much in. You have to be careful. And I think one of the other big things is when you're buying on a regular basis, you have to be careful not to put too much money in. It'd be much better to split it up. So instead of putting like $1,000 in, on one day, split that up over a couple days, see what the market happens. Because at the end of the day, worst case scenario, the markets go down, you can buy a dip. Best case scenario, the markets go up green. And now you've got some gain off the money you're already in. So I see it as a win-win either way. So that's why I've kind of been having some good fun with this, and I've really enjoyed it. But again, I might kind of adjust things as I go over time. I'm probably not going to be checking the markets as much over time because I'm not that kind of guy. I prefer to kind of just set and forget it. But I kind of enjoyed this to kind of be a little bit more active on things because I like opening the markets every day and seeing, like, is it a green day? Our account's growing, or is our margin account growing? Oh, hey, it's a red day. It's an opportunity to buy kind of thing. So I've kind of had some fun with this, but again, it's just a small amount of money, guys. Once again, it's only $2,000, and we're going to be kind of growing that over time. And one thing I do want to mention, I don't know if I showed you guys this, but currently we paid about $2.65 in Canadian dollars in dividends, and I will give you guys an update on my monthly videos, how much dividends we're getting from the margin account to help pay for that interest kind of thing. And you can see we've already accrued quite a bit of dividends, interest already this month, because we have more dollar amounts invested, right? So it's accruing more, and we should be getting our dividend payments over the next couple days. So we'll see if that'll cover the interest, and if it does, that'll be cool. But again, guys, I'm just going to keep doing the same thing, and for now on going forward, these margin updates I'll update it with my regular videos. I just wanted to do this one video on its own, just to give you guys a quick little update, just to kind of run this down and do a bit of a deep dive and show you guys my strategy. But like, definitely check it out, guys. And if you guys are interested in setting something up like this, go on ChatGPT, type in your stuff, set up your allocations, run the numbers, do some scenarios. It's a very helpful tool to kind of figure things out, create a game plan, and set things up. So yeah, definitely check that out, guys. But anyways, if you guys have any questions about this, let me know. If you guys have any experience with this, let me know. I'd like to hear it. And hope you guys enjoyed this video. Take care. Have yourself a good one, and I'll see you guys later.